When the average investor panics, the rich prepare. When the world freezes in fear, they buy. That's the rhythm of recession, not panic, but positioning. And today, I'll show you how the wealthy transform downturns into windfalls. There are 7 specific strategies the rich use to not only protect their money, but to grow it. And if you stay with me, I'll share 5 practical moves you can make right now to follow in their footsteps, even if you don't yet have millions to your name. Strategy 1. Fortifying with defensive assets. The first move is not flamboyant. It is foundational. The rich begin by reallocating into what are called defensive assets, investments that tend to maintain or increase in value when the economy slows down. US Treasury bonds. These are essentially loans you make to the federal government. In return, the government agrees to pay you back on a specific date, with interest. They are widely considered the safest investment you can make, simply because the US government has never defaulted on its obligations. Dividend-paying stocks. These are shares of companies that regularly distribute a portion of their profits back to investors. Not every company pays dividends. Many high-growth firms reinvest all their earnings, but stable, mature companies in sectors like utilities, consumer staples, and healthcare often do. These payments can continue even when the overall market is down, providing a steady income stream and cushioning the blow of falling share prices. Gold. Not merely for pirates and monarchs. Gold is what one might call financial ballast, steadfast and enduring. It does not yield interest, but it does not vanish overnight either. It has held value for millennia, outlasting empires and currencies alike. In times of inflation or uncertainty, gold often gleams the brightest. Healthcare ETFs. Exchange-traded funds are bundles of stocks that you can buy in one fell swoop. A healthcare ETF, for example, might contain shares of dozens of pharmaceutical companies, medical device makers, and hospital systems. Since people need healthcare, regardless of economic conditions, this sector tends to be recession-resistant. Strategy 2. Real estate with resilience. Let us now turn to land, not the sprawling estates of Victorian law, but income-producing, recession-resilient real estate. Multifamily housing. Apartment complexes, in plain terms. When times get tough, people consolidate households, delay buying homes, or downsize. That means increased demand for affordable rental units, and those who own such properties continue to receive rent checks, while others are watching property values fall. Self-storage units. A bit curious, but consider for a moment. When people move, downsize, or even lose homes, they need somewhere to keep their belongings. Demand for storage space actually rises during recessions, making this a surprisingly robust asset. Grocery-anchored retail, not sprawling malls filled with luxury brands, but neighborhood shopping centers where the anchor tenant is a supermarket. People cut back on extravagances, but they still buy groceries. These properties maintain steady foot traffic and reliable rental income. Healthcare real estate. Think outpatient clinics, dialysis centers, and medical offices. These buildings are leased to healthcare providers who serve an essential need for the community. That means tenants are sticky, cash flow is stable. It's not glamorous, but in recessions, glamour gets discounted first. Strategy 3. Liquidity for the hunt. Now we arrive at a strategy most overlook, but the rich never do. Maintaining liquidity. That is, keeping cash or cash equivalents close at hand, not for emergencies, but for opportunities. They don't bury it under the bed. They hold it in short-term debt instruments, things like treasury bills, high-yield savings accounts, and certificates of deposit. These offer modest returns. Yes, but more importantly, they're liquid, ready to deploy. When others are forced to sell stocks or properties in desperation, the wealthy are ready to buy. At discounts, at panic prices. It's a little like shopping Black Friday deals at the mall while everyone else is still stuck in traffic. Cash is not king. Cash, with timing, is king. Strategy 4. Alternative assets for a fragile world. Now then, some investments dwell outside the mainstream. That's where the wealthy often look next. Farmland. Yes, fields and crops. It doesn't crash with the Nasdaq. It doesn't go viral, but it feeds people and thus retains value. Some of the world's richest families own massive tracts of farmland for precisely this reason. TIPS, that's short for Treasury Inflation Protected Securities. These are government bonds, like the ones we discussed earlier, but with a twist. Their value rises with inflation. That makes them particularly appealing when the cost of living is climbing and central banks are hiking interest rates. Foreign currency holdings. Why bet everything on one economy, one currency? The rich often diversify into currencies like the Swiss franc or Japanese yen, historically strong and stable, especially when the dollar wobbles. Managed futures. These are funds that use complex algorithms to trade commodities, currencies, and financial contracts. They're designed to make money whether markets go up or down. They require expertise to manage, but they offer diversification most portfolios lack. High dividend ETFs. For those who prefer not to stock pick, dividend ETFs offer a simple path. These funds aggregate dividend-paying companies across sectors, delivering steady income and reducing risk through diversification. All these assets do one thing: they insulate against volatility, against inflation, against uncertainty, so they are ideal for an impending recession. Strategy 5. Real estate debt and distressed investing. Now we step into the smoke-filled room, where fortunes are not just preserved but made. The rich often buy distressed debt. This means they purchase the loans and bonds of companies or individuals who are struggling. The debt is cheap, sometimes pennies on the dollar. And if they play it right, they can turn that debt into equity, into control. They may step into a failed development, inject capital, restructure the loan, and emerge as the new owner. This is not for the faint of heart, but it's where outsized gains live. Strategy 6. Sovereign wealth signals. Now consider this. Not all the big moves are made by individuals. Some are made by nations, specifically by sovereign wealth funds, the titanic investment arms of governments, particularly those blessed with oil, gas, or trade surpluses. These funds are not impulsive. They are methodical, often managing hundreds of billions in assets. And during recessions, they do not retreat, they reposition. They buy commodities, not merely for profit, but for power: wheat, oil, lithium, copper, assets that the world cannot function without. It's not about speculation. It's about ensuring long-term influence in the supply chains of the future. They place bets on emerging markets, countries with young populations, rising middle classes, and untapped potential. Yes, the risk is higher, but so are the returns, and sovereign funds can afford to think in decades, not quarters. And perhaps most revealing, they invest in domestic infrastructure, roads, ports, energy grids. These are not glamorous, but they are foundational. Strategy 7. Data over drama. And finally, the quiet habit of the truly wealthy. They do not let emotion run the show. They use data, not drama. They track the 12-month moving average of the S&P 500 or other major indexes. If prices fall consistently below that trend line, it often signals trouble. They monitor credit spreads, the gap between yields on safe bonds like US Treasuries and those on riskier corporate debt. When that gap widens, it means lenders are nervous. They analyze inflation trends and central bank policy. If inflation is rising and the central bank is hiking interest rates to fight it, borrowing becomes more expensive and risky assets typically suffer. They follow frameworks, not feelings. They don't need to guess because they've built systems that tell them when to move, what you can do before the recession hits. You don't need millions to follow the path of the wealthy. You simply need to stop thinking like a bystander and start acting like a strategist. Here are 5 practical moves you can make, starting today. 1. Start your opportunity fund. Call it what you like: an opportunity fund, a dry powder account, or a strike reserve. The point is the same. Cash is not merely for emergencies. It is your ticket to take advantage of downturns when others are retreating. Start small if you must, a few $100s set aside each month, but treat it as sacred. When assets drop, this is the fund that allows you to buy while others blink. 2. Rebalance toward dividends, bonds, and essentials. Growth stocks are thrilling in bull markets, but they are temperamental companions in a storm. Reallocate your portfolio toward stability. Dividend-paying companies in essential industries, think healthcare, utilities, and consumer staples. High-quality bonds that pay you to be patient, and cash equivalents that hold their ground. This isn't about avoiding loss. It's about positioning yourself to gain steadily when others flail. 3. Own real assets, not hype. The rich don't gamble on trends. They own things that produce income-generating property, farmland, dividend-yielding stocks. These are tangible, enduring, and often boring, which is precisely why they work. Ask yourself, if the internet vanished tomorrow, would this still matter? If the answer is yes, you're likely on the right track. 4. Learn one alternative asset class deeply. You needn't master them all. Choose just one alternative asset class. REITs, TIPS, farmland, managed futures, even collectibles, and learn its rhythm. Understand what moves it, what protects it, and when it shines. In a world where most investors follow headlines, expertise in even one niche gives you an unfair advantage. 5. Track what sovereigns are buying and ask why. You may not have oil money, but you can observe what those who do are doing with it. Sovereign wealth funds are among the most strategic allocators of capital in the world. If they're shifting into wheat, water, or infrastructure, that's not noise, that's signal. Recessions are not punishments, they are resets. The question is, will you react or will you prepare?